we talk about setups on the leveraged ETFs that are on our premium watch list. So let's get going. Seasonality. Wait for it. That basically is the essence of the presentation tonight. I think you're gonna. I hope that you have an aha moment. I made this statement a while back, but observe things how they are, but see things how they can be. And then Mike came up with his yogiism, and I just absolutely love it. When you're talking about seasonality, it doesn't happen every time, but it does happen all the time, which is very prevalent within the market environment. Again, a reminder that materials that we present are for training purposes, and traders should always paper trade any new method prior to the risk of their own personal capital. So seasonality. Market timing, and seasonality are not the same thing. Market timing is based on short-term price patterns and trying to pick either market tops and or bottoms. However, seasonality is about anticipating how the market will behave in a given time of the year and taking a position before the change occurs, or be looking for the trigger to take a position before the change, as the change is occurring. Seasonality appears in stocks, it appears in commodities, seasonality appears in nature, of course. But by understanding the ebbs and flows of seasonality, traders can better position themselves to take advantage of buying and selling opportunities. Those who have been with us for a while, you may remember the gold trade that we did in June of last year. We bought some options on GLD, and then as gold was going into its June to August or October rally, and that was a seasonal move, expected move in gold. I think we got out of those options and made a really nice profit on them. You could have done the same thing by buying Nugget or GLD, the ETF GLD by itself. Remember, seasonality reflects a tendency. That goes back to that issue of probability. It doesn't happen all the time or every time, but it does happen all the time. And each year is different to some extent. So trade the charts. Let's take a look at some of these. One of the things I found as I was doing my some research, I've been doing about 10 years worth of research now on the IBD 50, and I was seeing an element of seasonality in the IBD 50. That was the first IBD 50 at the very beginning of each year, going all the way back to 2007. What I was seeing was that during the months from the close of the year into about the first week to in February, midweek in January, somewhere around there, is that if the index was going to, or the stocks on that list were going to make a push on up for a rally after the end of the year, that it would usually peter out and run out of gas around that time frame. And then it would go into a retreat that would last until the late March into early April time frame, and then it would rebound then, and typically from the April to July, August time frame is when the majority of those stocks would go on their biggest runs. Well, that seasonality basically refers back to the seasonality that's present in the indexes. Okay, here's basically on the S&P 500. This is 500. This is data from 1926 to 2004, and as you can see, you get a big upswing in January, but the returns in February, March are not as much. Matter of fact, they're oftentimes not positive at all. Then you get a initial push up in April. Why do you think there's a push up in April? And if anybody says taxes, yeah, but there's another reason. Refunds, how about last chance, April 15th, there you go, Susie, IRAs and 401ks. You get a big push, may seem to taper off a little bit, then you get a run back up into the summer. September has been historically not a great month to be, necessarily, trying to get long. So note the January effect, the summer effect, the end of the year effect on the indexes. This is the S&P, but each one of the other indexes has a very similar type pattern. But then there's days of the month. And this is from 1885 to 2001 on the Dow. And as you can see, the first part of the month and the last part of the month is when the advances on the Dow were the greatest. Well, that basically breaks down to that's when payday is. Those who are getting paid once a month, that's when it tends to spike up. Some people get paid middle of the month, around the 15th, you get a little bit of a spike up. But taking that information, how can we utilize that, to benefit our trading? I want you to ponder that question. And then there's the Monday effect. This is on the Dow. Mondays on the Dow tend to be really not, basically downside. So if I was looking to get out of a position in the, let's say I invested in the diamonds, the ETF for the Dow, would I want to be a seller on Monday or a seller on Friday? And that's how we can utilize this information to improve our ability to, does it, work every time? No, but this is a tendency. And that's a heck of a lot of data from 1885 to 2001 to take in consideration. So if I have to trade out of a, if you have a, like I know my wife worked for the government, had what's called a TSP account, thrift savings plan, and if I was going to be buying or shifting funds around in that, moving it into an index type fund, I would want to get out on a Friday and then get back in when either on a Monday or first thing on Tuesday, but Monday would be basically a better time to be buying. And so that's how we can utilize this information. So commodities or industries, do they tend to have seasonality? Well, yes, they do. Gold, oil, biotechs, and financials all demonstrate a seasonality that is repeated year after year after year. And here's the tendencies. Gold, the early rally tends to take place between sometime in January running through early February. Then it has a late rally that takes off somewhere around June, July timeframe through early part of October, late part of September, where you can anticipate that's when gold is going to rally. And one of the things for traders and for the big institution is this has become so habitual that it becomes like a self-fulfilling prophecy. Are there years when it gets whacked out of shape? Yes, there is. So let's take a look at, but if we're prepared and looking at our charts, recognizing that this is going to be the expectation, we can plan ahead and say, okay, if I'm going to trade gold, I would want to be trading it somewhere between sometime in January through February, and if it declines after February, that's one of the benefits we now have with the active trend trading premium watch list, is we have those top-notch leveraged ETFs that can go both ways if the individual traders want to do that. That's the way we will be trading going into 2017. Oil. Early rally, February through May. Late rally, July through October. Biotechs, early rally, January through February. Late, and I know some of you like to trade, who's online that likes to trade the biotechs? Gary, yeah, okay, Gary. So I figured this would be valuable information for you. You know, as you're looking at, we're going to look at some actual charts of the seasonality here shortly. But the late rally, July through December. Financials, early rally, February through April. Late rally, October through December. So one of the things that's very interesting, Mike was talking about earlier, was that the financials were already rallying into the end of the year, and then when the Fed decided to and then it got that a secondary boost from, of course, the Trump election, that just added fuel to the fire for the rally in financials. So let's get down into some of the charts, because I am a chartist, and this is what I like to do. So here's a chart of gold seasonality. Now this is just the straight gold, not the gold miners, GMS, but 40 years worth of seasonality from 1976, which was a very good year, through 2015. And as you can see, the dotted line is the 15-year pattern. The darker, black line is the 40-year pattern. And what does it, basically tell us? About the, mid part of January, gold has a tendency to start a run up that lasts until the first part of, week of February. And then it goes and drops back off. And as you can see, on the 15-year pattern, it's been extended out where this rally actually runs up until about the end of February. Then it pulls back, and then it kind of goes sideways for a while until we get into the month of June or July. You're actually moving into the last part of August, and then it goes into, normally goes into a very significant rally from there and peaks out around the end of, September, first part of October. So I find that exceptionally intriguing, and that it's basically repeated this pattern, where this is the data points of this, repeatable pattern that have happened for, both 15 years back and 40 years back. So at the Active Trend Traders, what we wanted to be is start being able to take advantage of the moves in the leveraged ETFs that emulate these particular, like in this case, the commodity of gold. So what did that look like if we went to a picture of nugget? Now, of course, the inverse of the gold index, gold miners ETF is DUST, D-U-S-T. But let's take a look. Okay, here's nugget. And this is just the last year's worth of information, data on nugget. This is a daily chart. And as you can see, nugget started the year last year down here around $3.54. Look at the date, 1/18. And then nugget went over, again, nugget's a crazy entity to trade, but it puts in great technical patterns that we can, that can be utilized for trading. But it went on a tear the first part of the year on this first little surge up, and this is basically taken the move from these lows to these highs here. And part of the things that we also train at the Active Trend Traders is okay, how to recognize that, how to get in, and then basically either trade off of the moving averages moving up. And so Nugget gave plenty of opportunity to participate. I'm not saying we're going to be able to jump in, get 310% and jump out, but to be able to participate on a little bit of that on the way up. And you do that 1 or 2 times a year on these entities and start compounding the returns to be very significant. And there was another surge, and that was in the there was another surge, and that was from right here at about the beginning of June, last part of May, and this time it ran from, again, 52 days, and it ran up 150%. That's from these lows to these highs. That was the amount of run. Again, that was not, again, I'll just reiterate, I'm not anticipate picking up that much of a move, but if you even cut out the middle of the move, and that's all you were able to participate on, or even the move from here up to breaking out, that would be a significant, addition for your trading for that year. So I really like Nugget. Again, the flip side of Nugget is Dust, D-U-S-T, and that's on our watch list also. So what about oil? Here's the seasonality chart going back 30 years on oil. As we can see, pull back in the first part of the year, and then basically a rally up. Let's put a little chart on here. You got to pull back the first part of the year into February, then you got a rally up, then a move sideways, and then a secondary rally, reflecting what I indicated on that one chart. And then in the October, late September, early October timeframe, usually you get a sell-off in oil. And this repeats, this cycle, this seasonality, repeats over and over and over again as a tendency for oil. So what about the leveraged ETF for oil? Well, as we see, follows a very similar pattern. Sell-off into the beginning of the year, hits its lows in February, then goes into a rally. This went into a rally into the midsection of the year about June. I think that may be a little bit, yeah, that's a, well, June time frame. Here's June, went into, and then it basically went sideways, dropped, and on this case, UCO, which is a 3-time leveraged oil leverage ETF, didn't quite emulate the chart exactly, but it did some of the same patterns. What kind of a return did UCO? Just one of the moves. 38-day period, 84%. That's from low to high again. And so this keeps impressing me, and this is one of the reasons why I input the leveraged ETFs on the commodities, gold and oil, biotech, and the financials. And think about how that streamlines our need to do our research and also our analysis on a weekly and a daily basis. We find that the entity will either be at a buy point or it won't. And taking this new information regarding seasonality, we can now kind of forecast out, and we can say, okay, hey, biotechs, I want to be interested in biotechs from the beginning of the year through about February. And then they tend to go sideways until about June. Then from June they take off and they run up a little bit and continue on up just about through the end of December. So is that information you can use to strategically plan out how you want to trade going into 2017. So LABU is the 3-time leverage, and you can see it does not follow the same pattern. This is partly due to just how these leverage ETFs work. But if you go back, here's the January into February, March, June, and then a rally. How did that relate here? So we get into the February, get a little bit of a rally, and it just went sideways, but around those time frames, like the June-July time frame, as you can see, if we know that it has seasonality, if we know it has seasonality, we could be anticipating, I'm at a low, I need to be ready, and it's in the middle of June. This tends to be, and I use that word very, loud and clear. It tends to be a time when these bounce, and sure enough, it bounces and runs up significantly. And this is part of the benefit of using the leveraged ETFs, and because with the leveraged ETFs, we do not want to be in a position for, multiple months. We want to be looking at days to weeks, in this case 38 days. And in part of our other training, I've talked about it. If I'm in a leveraged ETF, I don't want to hold it for more than 90 days, simply because of the backwardation and the other aspect, other things that happen with the leveraged ETFs because of what has to be purchased to emulate a three times the daily move of the individual underlying entity. So that's it for the biotechs. Dorothy asks, does biotechs have a long-term, uptrend? Dorothy, I have to pull up the chart on that for the individual biotechs and take a look at the weekly and the monthly chart on that. You may even want to go to the quarterly to see if it has been in a significant long-term uptrend. Because what we're doing this evening is not so much about the longer term trend, but recognizing that within each year, where our potential higher probability buy points or buy frames for the ETFs. One of the things, if it is, one of the things you can use this information, let's say you're hot on biotechs, and let's say it is in a longer term uptrend, you can still use this information to build your position. What time of year would you want to be adding to a biotech position? And you just take this and go, okay, typically January through March would be the time where I want to be adding to, and then taking the ride, and then it goes kind of dormant over the May, June through September timeframe, and then takes off again in October. This is the financials, excuse me. So financials. And so as we see, FAST, which is I believe it's a 2-time leveraged ETF of the for the financials, and it follows the same, almost the same pattern exactly as the other. And for those who are looking to initially, start looking at how, trading these leveraged ETFs, FAS might be a good starting point. It's not, and I'm not doing it as a recommendation, but it's a little less volatile than gold, and certainly less volatile than UCO, and so it would be maybe a better starting point for you. Also puts in really great patterns. Let's take a look at this. This is from as we saw in the previous chart, you get an October spurt, and this last October, this is 2016, this last October, it ran from the low to the highs over here, 56% in 30 days. Okay. So any questions? Yeah, assessing and evaluating these leveraged ETFs in these particular commodities and or industries is what I was focusing on towards the end of 2016, because while I like trading the IBD 50 stocks, at the same time. It seems like it's a never-ending ordeal or chase to try to find that one stock or those couple of stocks and all that kind of stuff. And while the IBD 50 has a really high hit rate and success rate, which I'll be doing another video on how my research for 2016 did turn out on the first IBD list of the year. It's time consuming if you have a lot of stocks on your watch list. And so with this approach, it has the potential for a good gain. At the same time, I'm not wrapping all my time up in having to analyze the stock. I know that these particular entities are going to move and move nicely. Now, will they move the same way they did last year? Not exactly, but if I'm ready at the particular time of year, we can be ready to move. So just really quickly, seasonality summary. Every year is different but the same. Tendencies are not exact, but they can provide an edge, and that's what we're looking for, an edge. They can show us when the probabilities are greatest and help shape our expectations. So I'm hoping that, and I'll be posting this video along with the presentation slides to the website. They're going to be accessible by anybody. Again, the value of this presentation tonight was so high that I wanted to get this in as many hands as possible. And so it gets us in the ballpark of when positive moves tend to happen. And so, for me, that provides an excellent, if you're close to being in the ballpark of the time for execution, that can give you an edge over somebody who's just going out there willy-nilly buying oil stock when oil stocks are supposed to come down and vice versa. So again, I'll just reiterate what Mike says. It doesn't happen every time, but it does happen all the time. So let's see, Eric, we bought an oil stock today. Can you go back to the seasonality chart on oil? I certainly can. There you go. From a seasonality standpoint, we bought the oil stock, and from a seasonality point, it appears like that's a crummy time to buy it. However, the chart was saying, and it was on the IBD 50, it was saying, buy me. Now, it may not get any, much higher than what it is right now, but we'll keep our stop loss on that really tight and reevaluate it in February if needs be. So, okay, lastly, I know there's some folks who have never been on one of our webinars, and we offer a webinar special through the end of January 2017. So if you would like to join us as an active trend trader and take advantage of our training and that type of thing, this offer will be going on until the end of January, and you can go to activetrendtraders.com, monthly membership introduction, and take advantage of 40% off the regular monthly fee, or if you want to go into the early warning alerts, you can save over 60% on just that system. That is just for the leveraged index ETFs system that Mike put together. So with that, that's it for tonight. And I want to thank you for your attention. And I have time to look at a couple of stocks. Okay, let's go over here. And for those who are, who are new, have never been on one of our webinars, this is basically the format of what we do. When we finish our discussion, we go in, and if there's a couple of, some time left over, we try to get it done within an hour, but there's some time left over at the end, and sometimes I'll stay a little bit longer, and we'll take a look at whatever stock you want to look at. Okay. You like Weibo, huh, Tracy? And so, yeah, if anybody has any questions they want to ask, separately, just let me, here is my email. You can shoot me an email. No, it's not DWSR, sorry. It is dww@activetrendtrading.com. There we go. Just follow up with you're welcome, John. So let's go and do an assessment on this. Okay, Weibo. And right now I'm just looking at the technical aspect of this chart. Tracer, we get a little bit of a pickup in the buying volume here, and we get a nice move up. We're through the 8-day. I'm always cautious on that first time it pushes up through the 8-day that it may do a retreat back down, similar to what it did over here earlier in the last year. However, it is giving us an indication that, hey, I may want to move higher. What are and I think from a weekly standpoint, very positive that TSI is just about crossed over, and it appears as if the momentum is starting to cross up. Now, will it make it back through that line? And because that's where basically that's the longer term trend, and you need to take a look at from here up to that trend line. It's about 12%. So we get a spurt up this morning. Have you already entered the trade? No. Okay. Yeah, it's consolidating nicely here, and like I said, it may spurt up, but its buying volume is going up. I'd also have to take a look at, how are the fundamentals on it by doing a stock checkup on it. But it is consolidating. So if I were going to be buying it, I would want to buy it closer down here into the 8-day moving average. Yeah, shakeout plus 3 up, that would put you in about 44.36. Again, I know the shakeout plus 3s can provide a really nice, can provide a good entry. I prefer trying to get it off the 8-day and or 20-day or 50-day, depending on what it's rebounding off of. Okay. Yeah, I'd be looking at that. I would pop over to, just real quick to the hourly chart and see what the hourly chart is telling us. And again, this is the 1-hour chart. The dashed line is the 50-period moving average, which equates to approximately the 8-day moving average. And so it's showing it that and it's pretty darn close to. I mean, it's showing that it's at about 41.93. The 8 here is showing that it's at 42, and so it looks like it's getting ready to, roll over from, being at the TSI high, and so, you can draw a line across here, and if you get if you get a drop down into, about that area, which equates to 42, 43, and a rebound, that might be a good opening for you. Okay, let's see what other stocks. Somebody asked. XL up, buy, sell, or hold. I don't know. Let's take a look. Of course, you have to be able to type in. Yeah, and typically, Joe, what I do is I don't necessarily say buy, sell, or hold. I just basically take a look at the chart and say here's what the technicals are telling me. There we go. It is demonstrating similar type pattern to the S&P, which or the S&P's showing a similar pattern to this, where it's pushed up into new highs, bouncing back down around to 20. It also has to digest this move where it came from here up to here. That's a 23% move on the XLF, which is a big move. So what we're seeing right now is digestion. And the question is that level going to hold? Right now, it is really close up to, if I got in down here, into XLF down here in this area on the rally, then if I break down below this point here, which is a swing low, if I broke down below that, I would want to take some of my profits off, some or all my profits off the table. I would not be buying unless I get a because it's really close to this resistance at 2387. I'd like to see it just a little bit more of a formation and drop back down. This may push higher and retest, and so in that case I would wait for another retest back down to the 8. Weekly charts, the TSI has already crossed to the downside, and I encourage folks, whenever you're looking at the TSI, go back and look at what's happened in the past on a weekly chart when the TSI crosses over. Does it tend to continue to push higher, or do you get a big push down? We have not had a huge sell-off, but we do have a bearish harami, and a bearish engulfing on a weekly chart, and it's working within a channel, or within a little flag there. So let's see, XLF, Tracy. I know I saw another. Did anybody else have? I saw it and I can't find it. Thank you, Eric. SEO. And SEO is the ultra short of oil. If oil does go into a nosedive, then we're looking at, this is looking very positive, like it may want to turn and run back up. It's we got a cross here on the TSI on the daily. Looks like it's getting a little bit stronger. It has been on a downtrend. It looks like the weekly is wanting to cross up. What could have anticipated? The SEO and the UCO can move in a crazy way. We're going into that time of year, if we go back to the seasonality on the oil stock, on oil. This is the tendency to be the time of year when it falls, and so a fall from here, it could bounce back up. What did it do last year at this time? Yeah, it went into the first of the year last year, did a little bit of a rebound, and then started falling as oil picked up middle of the year. or in the February, March time frame. So, yeah, that could be very interesting. Right now, bullish engulfing, and you're definitely close to the swing low here. And so, if you picked up here, your swing low is about 6% away. That's the only challenge I see on this particular one. Eric is, maintaining your position sizing, so you're never risking more than you would have lost on 4 to 5% on a full size position. This may be also one of those I turn over to and watch my intraday chart. What's the intraday chart telling us? Okay, it gapped down today and then rebounded. And it looks like it wants to continue moving up to the upside. Interesting. Or as I say, very interesting. If you move back up to the 50-day, that'd be about 12%. Move back up to its past highs, you're talking about a lot more. Again, with these leveraged ETFs, one needs to, we want to be mindful that we're not going to want to ride those for a long period of time. So either set a mental time stop that says in 6 weeks, I want to be out of this position no matter what, or no more than 90 days max, because the contango and the backwardation can wind up reaching up and biting you in the butt, and that is never any fun. So, okay, folks, I'm going to call it a night. Thank you for joining us. I'll get the video edited, and we, again, I hope that you agree with me that the value of tonight's presentation was such that that it was, I had to open it up to as many people as possible. Jim Paul, I see you're on the line. If you have any comments, you can let me know. I don't know if you've ever seen a presentation like this or not, but I can always count on Jim for giving me good information. Yeah, Jim, you want to talk? Go, Jim.
Sure. Happy New Year, everybody.
Happy New Year, man.
Yeah, I think I watched another presentation that you did that was sort of similar to this, and I always look back at the individual stocks, but this definitely gives you a really cool little heads up to what might be happening when in doubt. It's a great presentation.
Okay.
Thoroughly.
Thank you, and I think it's timely for the first row of the year. And so, hey, those of you who are also Bay Area moneymakers, we will have 2 webinars this month. For January, we will be live at the Masonic for the month of February. Right, Jim?
Right. I better call them and confirm.
Okay. Okay. So, hey, guys.
Because it's raining in the parking lot.
So, okay. Hey, I'm going to call it a night, folks. Thank you so much for your attention, and good night. Trade wisely. God bless everybody.